close were we in '08 to everything shutting down?
We were there. So Bear Stearns collapses in March 2018. 2008. They collapsed in March 2008. Fannie Mae and Freddie Mac collapsed in June 2008. Lehman Brothers files for bankruptcy September 15, 2008. Morgan Stanley was days away. There's no question about it. John Mack knew it. Everybody knew it. Morgan Stanley was days away. Behind it would have been Goldman, Citi, B of A,
Merrill.
Merrill was already toast. Yeah, Merrill I would include on that list. There would have been a sequential failure of every major bank in the United States.
I remember I got a call on a Sunday night right around September from a guy, my client at Credit Suisse, and he said, "Brian, are you coming to the office?" And I said, "Why would I come to the office?" And he said, "Lehman's going down and everything's happening and we have to liquidate all of our positions and it's all kicking off now. Get into the office."
Yeah.
And that was that weekend where everything was happening.
Yeah, it was a Sunday night. They filed on Sunday.
We thought, did we think Merrill was going down, but then it didn't, and then Lehman did?
Merrill was thrust into the hands of Bank of America.
Right, yeah.
This is when, that sort of came after. So Bernanke at that point intervenes. He truncated the crisis with guarantees of everything, and then Merrill's forced into the hands of B of A, and Abu Dhabi, they'd done this earlier, buys 9% of Citibank or bought options on Citibank stock. One by one, the sovereign wealth funds were prevailed upon to come in and buy up big chunks of the U.S. banking system, and the Fed did, QE1. And
we were close, though.
We were extremely close. It was happening. The dominoes were falling. If I line up dominoes and push the first one, they're all going to fall. Now, unless something intervenes, if you put a wall or a hand between two dominoes, one will fall and the other one won't. That truncation of the process is what the Fed did.
Okay. But they have to sell it, and if people don't believe they can do it, then people will panic anyway.
This gets into a very interesting conversation I had with former Secretary Geithner, which is, so the Fed, in effect, lifts the balance sheet of all these banks, prints, in the end, $4 trillion over the course of the next 6 years, bails out the system. Now, if somehow the Fed had normalized interest rates, got them back to maybe 4 or 5%, and normalized its balance sheet, got it down to, let's say, $2 trillion for a number, I'd be the first one to congratulate them. I'd say, hey, nice job, guys. You saved the world, and you got back to normal, and you're ready for the next one. That did not happen. They did, I'll say, save the world, put that in quotes, in 2008, but they've never normalized the balance sheet, and they've never normalized interest. And I said years ago that, because the question was, well, they started raising rates in 2015, then one in 2016, and then picked up the tempo. Why was the Fed raising rates in a weak economy? The Fed never does that. The Fed follows the business cycle. They don't lead the business cycle. So the way it normally works is, the economy's strong, it gets hot, labor market gets tight, inflation takes off, and the Fed goes, oh, we better, raise rates. They're always behind the curve. And then, but inflation gets, raise them again. And then finally they go too far, and then the economy cools off, unemployment goes up, inflation goes down, housing prices go down, and then the Fed goes, oh, well, we better cut, because we're in a recession. So the Fed follows the business cycle up and down, raises too late after inflation is taken off, and cuts too late after we're in a recession. That business cycle has happened 15 times or so since World War II. That's not what was happening in 2017, 2018. They were raising into weakness. Why on earth would the Fed raise into weakness? The answer is they were trying to get ready for the next recession, because the evidence is clear. It takes 400 to 500 basis points of rate cuts, or 4 to 5 percentage points of rate cuts, to get the U.S. out of a recession. How do you cut rates 4% when you're at 2%? You can't. Okay. You're going to hit zero. Then what do? QE4. Well, how do you do that when you're already at 4 trillion? You can't, because why didn't the Fed go to 5 trillion or 6 trillion? There's a confidence boundary there somewhere, psychological, invisible. So they had to get rates up and get the balance sheet down so that they could cut rates and do QE4 if needed in another recession. But here's the conundrum.
Right.
How do you prepare for the next recession without causing the recession you're preparing to cure? And I said they couldn't do it, and they didn't. December 24th, Christmas Eve, 2018, the Christmas Eve massacre, U.S. stocks were down 18% between October 1st and December 24th. And that's when Jay Powell had his epiphany, and he said, we went too far with that mid-December rate cut, or rate hike, rather. So
we still have never paid back what happened in '08.
Correct. That's
We've masked it with the printing of money and all these manipulations. And they were thinking, okay, with the recessions coming on the horizon, we have to actually start saving up for that. But the system can't handle that.
They cannot get there without causing a recession.
Causing another
and
recession.
They realized that. We were heading for a recession at the end of 2018. So Powell, to his credit, said, okay, no more interest rate hikes. They used the word patient. We will be patient. That's code. The Fed speaks in code. You have to get a little translator out. But patient means we're not going to raise rates until further notice, and we will let you know in advance if we do. So that's a signal you can put the carry trade back on. Because the only way you lose money on a carry trade is if short-term rates go up. You're borrowing short, lending long. You got currency exposure. If the Fed raises rates and didn't tell you, you'd get crushed. But they said, don't worry, we got your back. We're not going to raise rates. Then he went further by the spring and said, well, now we're going to cut rates. And this is, we're going to accommodate the economy. Again, another code word. We're going to cut rates. And then he goes even further and says, we're going to terminate quantitative tightening. Because, remember during the QE, I still run into people. It's like, I hate this QE, you're printing money. I said, sorry, that was over in 2014. They're burning money. The famous cartoon of Ben Bernanke with a manic look hanging off the strut of a helicopter, throwing helicopter money out. Well, picture Jay Powell with a pile of $100 bills and a shovel in a furnace throwing money into the furnace. That's quantitative tightening. The Fed started that in late 2017 and had reduced the balance sheet by about $500 billion, which was significant. So they were not only raising rates, they were reducing base money. It was a double dose of tightening, and it was putting the economy into recession.